So in the part 1 revision, capital gains, we are in the discussion of cost of acquisition, where we have completed predominantly many topics. So still we are left with cost of acquisition in certain cases. And we need to discuss 45 series where capital gains is taxable not in the year of transfer but in some other year. Slum sale we need to discuss. And what is 50C? One of the important provision in case of immovable properties. So that we need to discuss. And exemptions, capital gain account scheme, extension of time limit. If these items are discussed predominantly, I can say 80% of the topics in the capital gains we have covered. Okay, now, so what is cost of acquisition in certain special cases? Distribution on account of liquidation. Now you see when a company distributed any assets on liquidation, there is a section called 46. What that section says is, if a company on account of liquidation distributing any assets, not cash, distributing assets, transferring physical assets to the shareholders directly. Generally, this happens in closely held companies. Getting it? So, if a company distribute any asset on account of liquidation, it amounts to transfer, but company is not liable to pay any tax on that particular transfer. Instead, shareholders has to pay tax on transfer made by the company. How? Shareholders are redeeming the shares. Whatever the shares they are having, they are redeeming with the company. In return, they are cancelling the shares. They are relinquishing the right in the company. Yes or no? So they are cancelling the shares and getting the consideration from the company in the form of assets. Getting the point? Now, how to compute capital gains in the hands of shareholder on liquidation? Section 46 clearly says it is taxable for shareholder only, not for the company. So, full value of consideration is nothing but fair market value of assets distributed minus deemed dividend under section 2 clause 22 subclause C. Getting it? So, for shareholder, full value of consideration is fair market value of assets on distribution date minus deemed dividend under section 2 subsection 22 clause C. So, that is full value of consideration minus cost of acquisition is what in the hands of shareholder? He purchases shares, na? That cost of acquisition. If it is long term, then index it. So indexed cost of acquisition that you reduce. So final amount, whatever you get, is called as either long term capital gain or short term capital gain, or long term capital loss or short term capital loss. That's it. Now remember. Now shares company liquidated. So the shareholders have received some asset. Market value of the asset minus deemed dividend, that itself is considered as capital receipt, capital consideration. For that, cost of acquisition is this much. So balance is taxable as capital gains, right? Now I am holding this asset in my hand right now because company liquidated and they distributed me. This asset I am subsequently selling to somebody else. Suppose when company got liquidated, I am one of the shareholder. I received 10 lakhs worth of market value of the asset in my hand. Deemed dividend considered by the company was 2 lakh. So total consideration was 8 lakhs. This is what considered for the purpose of capital gain taxation minus cost of acquisition. Let us assume 4 lakh. So I made a profit totally 4 lakh because of the liquidation and I got asset distributed. Fine. Now this asset which I got, market value of the asset which 10 lakhs which I got, I subsequently sold this asset to somebody else. I sold it for some consideration of 25 lakhs. I sold after some 5 years or 6 years. I sold these assets for 25 lakhs. Now, what is cost of acquisition? This is the question. The cost of acquisition is fair market value of the asset distributed on the date of distribution. Now, I got this asset. How? Did I purchase this asset? No. This asset is something company distributed me. At the time, I already paid capital gains tax. Remember? So, the asset which is distributed to me, that asset market value is treated as cost of acquisition. So 10 lakhs is the market value rate when the company distributed me. That is considered as cost of acquisition. Now I sold this for 25. So balance is capital gain or loss, whatever it is. Now here you see, now whatever asset company distributed me, right, that I am selling it, right? Now is it a long term or short term? From which date you will consider? You will consider this tenure from the date company acquired. From which date? From the date company acquired. Anyhow, that is not a very big important provision also. So until now you can understand. Are you clear? Next. So that is one provision. So this I completed. Now, so this we completed. Now, what is cost of acquisition of the asset which you received as gift? If at all a shareholder received any SSE received any asset as gift, no. And that gift which suppose very simple. My friend gifted me land. Okay, on some occasion he gifted me this land. I am subsequently selling. I'm selling it to somebody else subsequently. What is the cost of acquisition? What is the cost? This is a provision where many will confuse. Now, first of all, you received gift na. You received gift na. So, in the year in which you received gift, no. At that time, is it liable for gift taxation? Check out. Is the gift received? Is the gift received taxable at the time of gift? Check out. Yes, 56. Under 56 subsection 2 clause 10, or earlier we have something called clause number 7, some amount is taxed already when you received this gift. Then this gift, if you subsequently sell it, the cost of acquisition is different. Suppose you received gift, no, at the time when you received the gift, it is exempt for you. At the time when you received this gift, no, nothing is taxable. You just received it as a gift, nothing is taxable. Now you sold it. Now what is cost of acquisition? Getting it? Simple. You received gift, ma. Getting it? You received a gift. I'll just move it. So you received the gift. Now the point is the gift taxable under 56 subsection 2 clause number 7 when you receive? If the answer is yes, how much is taxed? Identify. Now suppose the gift is exempted when you received. Getting it? Now in these two cases, subsequently what happened is this gift you sold to somebody at 25 lakh. I sold this gift ultimately to somebody else. I received gift and I sold it. Now what is cost of acquisition? Now when you received the gift, no, at that time it is exempted. Let us assume you received this gift on the occasion of marriage. Let us assume you received the gift from relative. Let us assume you received this gift from trust or association or university, somebody. Getting the point? Exempted. Now the cost of acquisition is 49 subsection 1 mode. As per that, cost to previous one. So whoever gifted me, no, at what price he purchased, that is cost of acquisition. Understood or not? See, when I received a gift, no, on the date of gift, the market value is 10 lakh. The market value is 10 lakh. But the fellow, no, whoever gifted me, at the time when I received this gift, no, it is exempted. So 49.1, what it says? Cost to the previous owner, not market value. Now, previous owner purchased it for 5 lakhs only. The one who gifted me, he purchased it for 5 lakh and gifted me. So cost of acquisition is 5 lakh. Are you clear? Suppose when I received a gift, some 3 years, 4 years back, I received a gift on the occasion of something, but it is not exempt. Whatever the gift I received, no, not a relative, not on the occasion of marriage, not an exempted source, taxable source. Now at that time when I received the gift, no, entire market value is taxed. Entire market value is taxed under income from other sources because it is exceeding 50,000 rupees. Now, what is the cost of acquisition? Fair market value at the time of 56 subsection 2 clause 10 taxation, whatever market value is there, no, at the time of gift taxation, that market value will be treated as cost of acquisition. So now, what is cost of acquisition? 10 lakhs. If you receive gift which is exempted, subsequently you sell this gift. Now computing capital gains, what is the cost of that gift? You received it as a gift which is exempted earlier. Getting it? Cost to previous one, 49.1. You received a gift that is taxed under other sources, under gift provision. That gift you subsequently sold. What is the cost of acquisition? 49 subsection 4 says the cost of acquisition is fair market value or the value that is considered for the purpose of calculation of income under 56 subsection 2 clause 10. The value of the gift that is considered for gift calculation under 56 subsection 2, that is treated as cost of acquisition. That's it. So with this entire cost of acquisition, non-depreciable assets, entire the discussion is completely over. We understood what is capital asset, we understood what is transfer, we understood what are various depreciable assets, how to compute capital gains, electricity company, how to compute capital gains, non-depreciable assets, how to compute capital gains, improvement means what, acquisition means what, all that issues we understood. Now we still have to understand special issues under capital gains. What are the special issues? First one, 45 subsection 1A. 45 subsection 1A, or you can also call it as clause 1A. Let us call it as subsection issue because they are somehow related. Getting it? So 45 subsection 1 is charging section, 1A is exception to charging section. Nothing but generally capital gains is taxable when in the year in which you transferred. Suppose I have a very big some jewelry I have, or let us assume some plant and machinery was there in my godown. Suddenly fire accident happened. Complete plant and machinery was destroyed. Getting it? Completely it was destroyed. Now I received insurance compensation, and you know what? The value of the machinery which was destroyed, the depreciable asset value, block value, just 10 lakh. But I received insurance company compensation 25 lakh. In spite I suffered a loss, in spite there is a damage happened, still I made a profit. Department want to tax that profit. That's why they brought a provision called 45(1)(a). If you receive any compensation on account of demolition, destruction, whatever reason, getting it, you are liable to pay capital gains. But when? Not in the year in which it is destroyed, but you will receive compensation within some 1 year or 2 years or 3 years, something. You receive compensation, right, at the end of the day. Somewhere, in some financial year, in some previous year, you will receive, right? In the year in which you received compensation, in that year, you have to pay capital gains on that particular asset which was destroyed. Now, for the purpose of 45(1)(a), what is full value of consideration? Whatever compensation insurance company paid me, money they paid me, no money. They paid asset only. Market value of the asset received. Getting the point? Minus what is cost of acquisition? The asset which was destroyed, no? Yes or no? If it is a block of asset, depreciable asset, cost of acquisition is block value. What is block value? I have already told you. Value of the block. Yes or no? So written down value, nothing but. So what is the cost of asset? We know. So depreciable. Non-depreciable assets, cost of acquisition. What is cost of acquisition? You purchased. Then whatever the price you paid. Previous owner, you got it from previous owner. Then cost to previous owner. So cost of acquisition provision is same. If it is long term, from which date you will consider? Long term or short term? From the date when you purchase or from the date when previous owner purchased? From that date till the date of destruction. Remember, once the asset got destroyed, the asset is no more. So period of holding will be only up to year of destruction. Year of transfer is year of destruction. Indexation is available only up to year of destruction. Able to understand. But capital gains is taxable. Let us assume in 20 to 23 financial year accident happened. But insurance company paid me compensation in 24-25 previous year. Capital gains we compute in 24-25 year only. We will not compute in 20 to 23. Getting it? But indexation facility, year of transfer, up to year of transfer, 20 to 23 only. Period of holding will be up to 20 to 23 only. That's it. That's what 45(1)(a) says. Next, 45 subsection 2. What 45 subsection 2 says? It's nothing but it is talking about conversion of capital asset into stock in trade. Capital asset converted into stock in trade is also treated as transfer. Now, when capital gains will be computed? Not in the year of conversion. Year of transfer is year of conversion only. The moment you convert, you transfer the capital asset by default. But capital gains we will not tax immediately. Capital gains we will collect. Capital gains we will tax when you subsequently sell the stock in trade. You will sell that item, no, in the form of stock in trade. Whenever you are selling, at that time we will compute capital gains. What is the full value of consideration? How much? Whatever the price at which I sold, at that price will you tax it? No, very simple. Let's look at the calculation. I purchased some land and building, non-depreciable, personal land and building. I purchased it for 10 lakhs. Somewhere in 2004, 2005. Getting it? Now in 2021-22, I started real estate business. Getting it? This land and building I converted into my stock in trade. I want to sell this land and building. I converted. As on this date, market value, fair market value, as on the date of conversion, the fair market value of this particular capital asset is, let us assume, 1 crore. Getting it? 1 crore. When I purchased it is 10 lakh. When I converted it is 1 crore. Now, in 23-24 financial year or 22-23 financial year, I sold it for 2 crore. Sudden rise in the real estate, I sold it for 2 crore. Now, what are the implications? Very simple. In my business, so sale value in my business is what 2 crore minus what is the purchase price in my business, my PGBP income. Purchase price is market value on the date of conversion. The moment you convert, that is cost of acquisition. That is purchase price for the business. So what is the price at which you consider this as a purchase price? Market value on the date of conversion. So the moment you converted capital asset into stock in trade, it becomes a business asset. It becomes a business purchase. So at what price you will record in books of accounts as purchase cost? Market value on the date of conversion. So 1 crore. So 1 crore profit. This is taxable under PGBP. Not only this. Now, you see here, no, actually you purchased it for 10 lakhs, but you are ultimately selling it for, you purchased it for 10 lakh, you are ultimately selling it for 2 crore. So 1.9 crore profit actually, but here we taxed only 1 crore. What about remaining 90 lakhs? They are liable for capital gains. How? Now, conversion happened when 21-22. In this year, this is year of transfer. Getting it? Period of holding. Just a minute. So period of holding will be considered up to conversion date. Indexation will be given up to conversion date. Now, first of all, to compute capital gains, what is full value of consideration? Fair market value on date of conversion, 1 crore. Minus cost of acquisition, as usual, 10 lakh. If it is indexation, index it. So balance is 90 lakh. Now when you're indexing, up to which year you will index? The asset is sold in 22-23, but conversion happened in 21-22. Indexation will be only up to year of conversion, because that is only treated as year of transfer. But taxability will be in the year in which stock in trade is ultimately sold. So that's about this one. Subsection 2. Now subsection 5. Compulsory acquisition of capital asset by government. If government has compulsorily acquired any capital asset, what is the consequence? Very simple. Whenever asset is compulsorily acquired by the government, that is year of transfer. But capital gain is not taxable in that year. Capital gain is taxable in the year in which you received the compensation. Getting the point? In which you received the compensation. Suppose government compulsorily acquired my land. So in 21-22, my land has been acquired by the government. Compulsory acquisition by under Compulsory Acquisition Act, government acquired my land in 21-22. But 22-23 only, they paid me compensation of 25 lakh. Let us assume they paid me a compensation of 25 minus what is the cost of acquisition? This land I only purchased, not previous owner. Let us assume. So I purchased it for 5 lakh. So that's it, 5 lakh multiplied by indexation. Base theory, denominator is what? When I purchased. Some 4-5 year I purchased, that index number you put. Now when I received compensation, 22-23 I received. No, you transfer the land to government in 21-22. So 21-22 compulsory acquisition year. That year index number only you should put. So indexation is available only up to year of compulsory acquisition, because it is only treated as year of transfer. Period of holding will be computed only up to year of acquisition, date of acquisition, compulsory acquisition. Are you getting the point? Now that's it. Now in this 45 subsection 5, many students are having doubt regarding final order, interim order, all that queries. So what is that regarding? I'll tell you. Now you see here, this is important for MCQ, final order, interim order, 45 subsection 5. So my land is acquired by central government in 21-22, right? Yes. But but you know, they have to pay me compensation in 22-23. They have to pay me. But it was not yet decided. Compensation, how much to pay? Government not yet decided. But what they did, 10 lakh rupee amount they paid me through an interim order. Through an interim order, they have paid me 10 lakh rupee advance. Just immediately in 21-22, somewhere in the March they compulsorily acquired. Somewhere in the April or May 22-23, they paid me compensation some 10 lakhs advance only. That is not full compensation. In 23-24, they released a final order. In this final order, the compensation is fixed at 1.2 crore. Already 10 lakhs paid. So 1.1 crore they have paid to my bank account in 23-24 ultimately. Now, when the capital gains is taxable, technically speaking, the moment you receive even part of the original compensation, in the year in which you received compensation, that is taxable. Now, if I want to tax in 22-23 itself, I got 10 lakhs, right? Now, can I compute capital gains? You don't know what is the full consideration. First of all, remember, as on this year, you don't know how much is the consideration. You received 10 lakhs as a token. That's it. What is the consideration you received? Full value of consideration. To compute capital gain, what is the consideration you received? You must know, right? So, the 10 lakhs only you received as an advance. Ultimately, in 23-24 only you came to know, my consideration is 1.2 crore. Now, tell me, in this year, consideration is 1.2 crore. But this 1.1 crore government paid in 24-25 year. Let us assume the 1.1 crore pending amount government paid in 24-25 year. Ultimately, when the capital gain is taxable, 23-24 only capital gain is taxable. Why, sir? We have not received fully. No, you received part of it already. In 21, in last 22-23 itself, you already received part of it. But we didn't tax. No. Why we didn't tax? Because we don't know full consideration is how much. Only through final order we came to know. Okay, so once final order comes, part of a consideration, if at all, already received. Whenever final order comes, it is taxable. Suppose, I did not receive this 10 lakhs, 22-23. In 23-24, final order came 1.2 crore. Directly consideration I received in my hand only in 24-25. Then in 24-25, capital gains is taxable. If at all you receive compensation partly also, whenever you receive compensation partly, in that year itself, full compensation, whatever is there, we will tax it. If at all, full compensation, you don't know, then we will wait until final order. Once final order comes, in that year, we will tax it. Whether you receive full compensation fully or not. Now, in addition, what is cost of acquisition? Cost of acquisition is nothing but whatever cost of acquisition, cost of improvement, all that indexation, everything you claim. Fine. Suppose after 2 years, you filed a case against the government. and you got additional compensation, enhanced compensation, you received enhanced compensation also, that is also taxable in the year in which it is ultimately received. So if any enhanced compensation is received, it is taxable in the year in which it is ultimately received. Clear? Now, what is cost of acquisition or improvement for enhanced compensation? Zero. For enhanced compensation, can I claim transfer expenses? No. However, you can claim legal expenses to get this compensation. So you reduce it. Balance amount is treated as a, balance amount is only treated as a long term or short term, as the case may be. If when you compute original compensation, or when you got original compensation, you computed capital gain, at that time if it is long term. Enhanced compensation also, long gain, whatever gain is there, that is long term. Are you clear? See, I'm not going in depth because this is not the time to go in depth. You must know all this. I'm just making you to recollect all the concepts. This is a recollection. This is a revision for recollecting everything. Getting it? Then, sometimes along with compensation or enhanced compensation, you will also receive interest because government is paying you late. That interest is taxable under other sources. Flat 50% deduction is there. Next. So 45. Subsection 5 is also completed. Now 45(5)(a). 45(5)(a) is regarding specified agreement cases. What is it? Specified agreement. Very simple. You are having a very big land. So let us look at this example. So you'll understand. Very simple. Okay, on this there is no problem. You are having a very big land. So one builder approached you. So he told he will construct a very big building. Like this, 2 buildings he will construct on this land. Land is yours only. Okay, but the investment on this land, 2 buildings, building 1, building 2, like this, a builder will come and construct everything. Once everything is over, once completion certificate comes, what builder told is entire building 2 plus land put together, you only keep it. Now this building and this land portion, I will take it. So you are the owner of the land fully. First of all, entire land you are only owner. But after I constructed 2 buildings, 1 building I gave it to you. In return, what you did? You gave me land. In return, what you did? You gave me the land portion. So this land is not mine of 50%, but building is mine only. So that you gave me. In return, what I gave you? I gave you 1 building. Earlier, yours is an empty land fully. Half the land you gave me. Remaining half the land, I constructed building and gave it to you. This is coming under 45 subsection 5(a). What this section says, if a landowner entered into a specified agreement with a builder, getting it, and the builder has constructed a building, getting it, only on receiving completion certificate, you are getting consideration. You transferred land indirectly. Here, 50% of the land you transferred, actually speaking, in the name of the builder. But in return, what you got? You got a building. You got a share in the project. Yes or no? Share in the development project. So this is a real estate development project. In this, you got 50% share in back. Getting it? Now, suppose this project started in 21-22. You hand over the land in 21-22 or 20-21. You hand over the land that time itself. But at that time, we will not tax it. At that time, we will not tax capital gains. When we will tax, the completion certificate was issued in 22-23 financial year. In this previous year, completion certificate is issued. In this year, completion certificate is issued when 22-23. So now once completion certificate is issued, at that time for you capital gains will apply. Now what is the consideration you received? Consideration is nothing but stamp duty value of project value you received. Whatever the stamp duty value of the project that you received, now building stamp duty value, that value on date of completion certificate. So that will be the full value of consideration minus cost of acquisition is what? Now earlier you are the owner of 100% of the land. Now 50% you transferred. So whatever that 50% land you transferred, no, that cost only you should reduce. So because that 50% land you transferred, on the balance land you got a building. Very simple. Simple example I'm telling you. So that cost of acquisition you claim. So balance will be the capital gains. Are you clear? Now, this entire capital gains, 45(5)(a), what it says, this is taxable in the year in which completion certificate is obtained. Now, what is the full value of consideration? Stamp duty value on the date of completion certificate plus if at all builder pay you extra cash also, that also we will add. So, both together is called as consideration received by you because of the transfer of land. Are you getting it? Suppose, before completion certificate issued by the local authority, before that itself, you sold the share in the project. See, what are you getting? What builder promised? Dear so-and-so landowner, out of your land, give me your land. I will construct 2 buildings. 50% of that land and building, I will give it to you back. 50% I will keep it. This is the agreement. Now, completion certificate is coming in 22-23. But in 21-22 itself, the landowner, he sold his 50% share to somebody else. At that time, 45(5)(a) will not apply. Getting the point? 45(5)(a) will apply only if the landowner keeps his ownership in the project on the date of completion certificate. On the date of completion certificate, still you are the owner only. You did not transfer to anybody. You waited for real estate share project. So that time this logic will apply. That's it. Now fine, right? Everything now you understood, right? Subsequently, no, 20 to 23 year completion certificate is issued. At the time, still in the particular land, 50% of land and building, I am only keeping it with myself. So stamp duty value of the building, whatever on the completion certificate, whatever I received, that is consideration plus cash amount minus 50% of the land I transferred. No. So what is the cost of acquisition of 50% of the land which I transferred? So that I reduced. So balance is the capital gains. Fine, very good. Now you know what happened in 24-25 year. In 24-25, this whatever 50% of the land and building which I am having, in that project, I sold to somebody. I sold it for 5 crore. Now what is the cost of acquisition of that 50%? Whatever, what is that? What is cost of acquisition? That is nothing but the cost of acquisition is nothing but stamp duty value on the share of project. Stamp duty value in the project. Stamp duty value of your share, whatever is considered for 45 subsection 5A. For 45 5-year taxation, whatever stamp duty value that is considered, no, that itself is treated as cost of acquisition. Are you clear? That's it. So with this, another special issue is also over, which is 45 subsection 5A. Next, slum sale. Slum sale means very simple. Suppose you started some business, some 3-4 years completed or 5 years completed. The business has got really very good value. You created a lot of value. Now somehow you want to retire. Very simple. You can sell your business as it is. Business itself you are selling. You are not selling any asset in the business. You are not selling any car. You are not selling any bad building of the business. You are selling business itself to somebody. Sale of an undertaking. Getting the point? Or a unit or a division in an organization. Getting it? You are selling that organization itself, unit itself to somebody. Business itself to somebody. So that is called slump sale, lump sum sale. Now, in slump sale, how to compute capital gains? How to compute capital gains in slump sale? Getting it? What is full value of consideration? Nothing but full value of consideration of all the assets you transferred, or full value of consideration of fair market value of the assets transferred, or fair market value of consideration received, whichever is higher. Suppose I am transferring the business to somebody, right? Transferring business means what? I am transferring all my assets and liabilities, everything. So what is the market value of the assets I transferred? 1 crore. Since I transferred this business, I got something else. The other person paid me cash, or the other person paid me some land. What is the market value of the consideration which I received? Some 1.2 crore. So for slump sale, what is the full value of consideration? 1 crore or 1.2, whichever is higher, 1.2 crore minus. What is cost of acquisition and cost of improvement? Nothing but net worth of the undertaking. Whatever business I transferred, right? That business net worth value is zero. That itself is treated as cost of acquisition and cost of improvement. No indexation, nothing. Getting it? Now, how to calculate this net worth? Assets minus outside liabilities. Getting it? Now, assets, what are they? Non-depreciable assets. Whatever balance sheet value, nothing but book value. Depreciable assets, block values. Depreciable assets, block value as per section 43 subsection 6. Getting it? So block values we will take. Getting it? Minus outstanding liabilities, outside liabilities, you reduce it. So you will have net worth calculation. So that net worth will be treated as cost of acquisition. Let us assume net worth is 80 lakhs. So balance 40 lakhs is treated as capital gain. Now is this long term or short term? If you started this business 3 years back, more than 36 months, then it's a long term. If the business started so and so date you started, now you are selling this business, right? If the gap is less than 36 months, then it's a up to 36 months. If the gap is up to 36 months, then it's a short term. Then accordingly, capital gain will be a short term capital gain. So what is the criteria for slump sale? 36 months is a criteria to decide whether it's a long term or short term. Why you need this criteria? In order to decide rate of tax. If it is a long term, flat 20% is the rate of tax. If it is a short term, normal rates of tax, not 111A. 111A is for shares, not for slump sale and all. For clarity, 50B is over. 50B is over. Getting it? So special issue is over. This is over. 50B is also over. Now, full value of consideration in case of immovable property. Generally, if you sell immovable property, what is the consideration? At what price you are selling? Check out. Compare that with stamp duty value. Compare that price with the stamp duty value. Now, suppose for immovable property, whenever you sell, So whenever you sell any immovable property, what is the full value of consideration? Actual consideration received or stamp duty value, whichever is higher. Provided there is one condition. Suppose here no, generally actual consideration. Suppose if stamp duty value is more than 110% of consideration. Suppose if stamp duty value is more than 110% of consideration, then stamp duty value. If actual consideration, if the very simple, let us take one example. Suppose I sold it for 95 lakhs. Stamp duty value is 120 lakh. Stamp duty value is what? 120 lakh. Okay, but I sold it for 95 lakh. Just a minute, ma. Emergency call. Yeah, sorry. So I sold land. Okay, some land and building. I sold it for 95. I received 95 lakh. But you know, stamp duty value was 120 lakh. Now, is 120 more than 10% of, is the stamp duty value more than 110% of actual consideration? Actual 95, right? 95 plus 10%, 110% is 104. Stamp duty value is more than 110% of actual, which means the stamp duty value 120 will be the consideration. Suppose no, stamp duty value is 97 lakh, whereas actual consideration is 95. Now, 95 into 110, 110% is 104. Getting it? So, if stamp duty value is greater than 110% of actual consideration, then stamp duty value. Otherwise, actual only. Nothing but indirectly, what the law says is, if at all stamp duty value and actual consideration, the difference is more than 10%, then take stamp duty value. If the difference is not exceeding 10%, up to 10%, market rate and stamp duty value can vary. In that case, actual only we will consider. If the stamp duty value is more than 10% of the actual consideration, then stamp duty value only we will take. Now, stamp duty value means which stamp duty value? On the date of registration, or on the date of agreement. On which date you should take? You should check the stamp duty value. Registration date stamp duty value or agreement date? Generally registration date. Suppose you received some advance amount before you sell the land, you received some token amount, and you received it on or before date of agreement. So you enter into agreement, no? So on or before date of agreement, you received some token amount. Getting the point? And that amount is received by other than cash, electronic mode, permitted electronic mode, account to pay check, account to pay bank draft, or any other electronic mode you received, then stamp duty value on date of agreement will prevail, not date of registration. Suppose no, you have not received advance at all, or you received advance in cash, or you received advance after the date of agreement, then agreement date stamp duty value will not apply. Stamp duty value means registration date only. That's it. So first identify which stamp duty value apply in the case. In exam they will give you a question. Identify which stamp duty value, registration or agreement, fix. Registration agreement, something you fix. Then that stamp duty value compare with 110% of the actual consideration. If this stamp duty value is higher than 110% of the actual, then stamp duty value will be the full value of consideration. Similar logic will apply for gift taxation also. If you receive any immovable property as gift, so stamp duty value you need to consider. Which stamp duty value? Stamp duty value on the date of registration if the gift is received without consideration. Suppose if it is for inadequate, means you paid some money, then stamp duty value, agreement data, registration data, any of these two will apply as per the provision. Getting the point? If as on the date of agreement some advance is received, and the advance is received by any mode other than cash, then stamp duty value on the date of agreement will apply. So that STV compare with actual. If it is more than 110% and the difference is more than 50,000 rupees, then gift provision will apply. 56 subsection 2 clause 10. That's it. At this speed, if I teach also, you should understand. If you are unable to recollect what you read, that means you have not studied properly. So with this, 50C is also completed. That's it. Next, exemptions under capital gain: 54, 54B, 1037, 54EC, 54F, 54D, capital gain account scheme, and extension of time limit. So what are all this? Now you see, some full value of consideration, some 10 crore minus indexed cost of acquisition or cost of acquisition, whatever as the case may be, some 7 crore. Getting it? So what is the capital gain? Long-term capital gain or short-term capital gain? Some 3 crore. Now, this is how you compute the gain. So how to compute this consideration? How to compute this cost? Everything is what we are discussing all these hours. Now, here, if you go and now you got gain, right? Suppose you don't want to pay tax on this. You have an option. Invest this amount. What? Invest this amount. Invest it as per 54 series sections. As per the rules given there, you invest it. Getting it? If you invest the amount as per the 54 series, whatever the amount is applicable, you need not pay tax on this. That 3 crore will be exempt. Balance taxable gain will be 0. What are the investments? So there is a section called 54B and 10 subsection 37. Both are talking about urban agricultural land. Suppose you transfer urban agricultural land. Okay. This land, before you transfer, 2 years you are only using it, or your parents are using it. The land, urban agricultural land which you transferred, you are using it before the date of transfer for 2 years for agricultural purpose. Whether it's a long term or short term, doesn't matter. What you transferred is urban agricultural land. Before transferring, you are using it. Suppose the land which you transfer, it is through compulsory acquisition by government. Because of compulsory acquisition, the urban agricultural land which you are having, government acquired. And before acquisition, 2 years you are only using, or your parents is using. Then government acquired, compulsory acquisition. That is also a transfer rate. Capital gains will apply rate. It is exempted. 10 subsection 37 says any compulsory acquisition of urban agricultural land which is used by the SSE or his parents or HUF or his family for 2 years preceding the date of compulsory acquisition, the capital gain or loss, whatever comes, is exempted. If it is loss, ignore. Gain, exempted. Sir, it is not compulsory acquisition, sir. I have an urban land, sir, which I am using it from the past 2 years or more than 2 years, sir. And I sold it to my friend. So full value of consideration is there. I have got a profit of 3 crores, sir. It's not compulsory. 1037 will not apply. What should I do? Buy another agricultural land. What is it? Buy another agricultural land. Sir, should I buy urban? No need. You can buy rural also. So whether you buy urban or rural doesn't matter. Buy within 2 years. Within 2 years from the date you sell the original land, within another 2 years you buy another agricultural land. Enough. Whatever. How much price? What is the profit? You got 3 crore. I have got a 3 crore rupees gain. So buy with another 3 crore land. That's it. So capital gain is balance 0. You should buy this amount. This entire 3 crore should be invested in another agricultural land within 2 years from the date of transfer of the original agricultural land, which is for 10 crore. So that is 54B. Now there is a condition. Now you are buying a new agricultural land, right? Yes or no? By buying, what you sold one asset, you got a profit. That profit, if you invest in another asset, same asset, the profit whatever you got is exempted from payment of tax. So now there is a condition. You purchased another land, right? That you should not sell it for 3 years. Lock-in period is there. This 3 years, there is a lock-in period. For how many? 3 years lock-in period. What happens if you sell the asset once again within lock-in period? Whenever you sell, at the time, what you are selling is a capital asset, right? Capital asset, right? At the time when you sell, let us assume you transferred it in 22-23. You purchased this in 23-24. 24-25, this 3 crore worth of land, you are selling it for 5 crore. Now what is the cost of acquisition? You purchased it for 3 crore, no? Minus earlier when you purchased it for 3 crore, capital gain 3 crore is exempted, no? How much is exempted? 3 crore. So from the cost, earlier exempted capital gain reduced. Balance cost is 0. So 5 crore minus cost of acquisition, 5 crore is taxable in that year. Suppose in this case, 54B, you sold for 10 crore. You purchased for 3 crore, right? This 3 crore, if it is a rural agricultural land, this rural land you sold within lock-in period. Capital gain computation itself will not come. So if rural agricultural land is purchased under 54B, that rural land is transferred within lock-in period, retaxability will not apply indirectly. That's a loophole created. Why? Under 54B, except 54F, 54EC, except these two sections, in all other sections, how if a new asset is sold within lock-in period, how retaxation wordings they drafted? They drafted wordings like, on transfer of new asset within lock-in period, while computing capital gains, cost of acquisition shall be reduced by earlier exempted capital gains. This word they used, which means if new asset when you transfer within lock-in period, if capital gains is applicable, then only retaxation will apply. Clear? I hope you should be able to recollecting this. I'm just reminding you. I thought of not to cover this point, but I'm covering. Suddenly it came in my mind, so I covered it. Okay, because some students may not know the difference exactly how to retax, these items. So 54F, 54EC, retaxation is different. 54, 54B, 54D. In these three sections, retaxation is different. In 54, 54B, 54D, if the new asset is sold within lock-in period, When the new asset is sold now, which means that is also a transfer of capital asset now. At the time you compute capital gains, no. At the time you will reduce cost of acquisition, no. Cost of acquisition means what? Whatever the price of the new asset. That amount you already claimed exemption, so you reduce it. Balance only cost of acquisition you will claim. So that's how retaxing will apply. I cannot give detailed explanation on this. I can only give that in regular class. Okay, already 1.5 or 1 hour 40 minutes first part is there. Now already 40 minutes is there right now until now. Getting it? So more than 2 hours 15 minutes until now. Another 15 to 20 minutes will take. So that's 54B. Next. So 54B over, 1037 is also over. 54B over, 1037 is also over. Now 54. What is 54? Suppose you sold a residential house property. You sold what? Residential house property, which is a long-term capital asset. Which is a long-term capital asset. This one, and this one. In these three sections, the original asset must be long-term. The original asset must be long-term. Whereas in 54D, 54B, 1037, the asset can be either short-term capital asset, the asset can be either long-term. So only in 54, only in 54 EC, 54F, the original asset which you are transferring must be a long-term. So you transferred a long-term residential house property under 54. You transferred a house. You computed capital gain. You have got some 5 crore capital gain. If you want to claim exemption, buy another house. Provided in 54, no. What is the capital gain amount? First of all, what is the capital gain? Suppose if the capital gain is exceeding 2 crore, you can only buy one house property. One house property. Either you can buy or you can construct. If you want to buy 2 years from the date of transfer of original house, if you want to construct 3 years from the date of transfer of original house. So original house, whatever you transfer, no, on that you got some 5 crore capital gain. If you want to claim exemption for this 5 crore, invest that 5 crore in another house property. If you want to acquire, within 2 years you acquire. If you want to construct, within 3 years you construct. If the capital gain is more than 2 crore. Suppose if the capital gain is less than 2 crore. If the capital gain is less than 2 crore, I'll just show you. Yeah. Suppose exemption. If the amount of capital gain is more than 2 crore, one residential house you can buy in India. Okay, purchase within 2 years after the date of transfer or construct within 3 years. If you want, you can even purchase in advance. Like before you sell the house, you purchased another house, you shifted into that house and then you sold it. So how much in advance you can purchase? 1 year before the transfer only you can purchase. Suppose I purchased a new house in 2021 and I sold my old house in 23-24. No, this amount is not considered as investment. Suppose you purchased a new house in January 2022 and you sold your old house in August 2022. Means when you sell, the gap is 1 year in advance, less than 1 year. That is only considered as investment. Getting it? Or once you sell, later on you purchase, that is also considered as a valid investment. But remember, only if you invest in one house, only one house investment is considered as 54 investment. Getting it? Now, or you can even purchase 2 years after the date of transfer, or you can construct within 3 years from the date of transfer. Getting it? Suppose if the capital gain amount is not exceeding 2 crore, then if at all it is not exceeding, see, whether it is less than 2 crore or more than 2 crore, one house if you buy, whatever the value of the house you bought, that is exempted. Getting it? But if the capital gain is below, less than or equal to 2 crore, no, you have an option. You can invest in 2 houses. Whatever the investment in these 2 houses put together, you can claim for exemption. So either you can purchase or construct 2 residential houses. Getting it? So if it is purchase, within 2 years you should complete. If it is construction, within 3 years you should complete. That's it. Now, whether it is more than 2 crore, less than 2 crore, doesn't matter. You purchase a new house, right? Lock-in period is 3 years. If you transfer the new house or houses within lock-in period, capital gain again will be applicable. Earlier given exemption, whatever, will be reduced from cost of acquisition while computing capital gain on transfer of the new capital asset. Then 54D, not an important provision at CA into, leave it. 54 EC. Here what you are doing is, you are transferring long-term capital asset being land or building or both. Remember in 54 residential house property. Means compulsory it's a land and building or only building, doesn't matter. Only land if you are selling, 54 section will not apply. 54 EC, even if you sell a land, the section is applicable, or only building or both land and building. It can be residential or non-residential, doesn't matter. It can be depreciable, business related building also, not an issue. Getting it? But that asset must be long term, means for this particular immovable property, you are the owner for more than 24 months. Simple logic. Now, if at all you got any capital gain on these land or building or both, the capital gain amount you invest in bonds, long-term specified bonds, within 6 months only if you invest, whatever amount you invest, that much is exempted, provided maximum exemption cannot exceed 50 lakh rupee. Maximum exemption under 54 EC in respect of a particular transfer cannot exceed 50 lakh rupee. Next, 54F. Here in 54F, no, original asset which you are transferring is any asset which is a long term but not residential house. Getting it? If you sell a land, no, vacant land, that is eligible. But if you are selling a residential house, 54F is not open. So if you sell any asset, jewelry I sold, or my business itself I sold to somebody under slum sale, I have got a capital gain. Now, whatever the amount at which you sold, no, sale consideration. If you invest sale consideration in buying a new residential house, capital gain is exempted. See, in all, very simple. I'll show you a simple calculation. So you just remember this point, 54F. Again, some students will do mistake if they don't remember this point. Suppose, no, I crore my asset, original asset for 10 crore. Minus cost of acquisition is 8 crore. Okay, my capital gain is long-term capital gain or short-term 3 crore. Minus, generally if it is 54, 54B, 54D, 54 EC, if I invest 3 crore I can claim deduction. So balance is 0. But if it is 54F, no. If you want to claim 3 crore exemption, you should invest net consideration. Suppose, no, I invested 10 crore in the new house, then 3 crore is exempt. Suppose I invested 5 crore only. In this example, I invested only 5 crore to buy new house. Then out of 3, proportionate exemption, 3 crore. See, if you invest entire net consideration, if you invest, 3 crore is exempt. But you invested only 5 crore. So 1.5 crore only exempted, nothing but the amount of exemption is equal to long-term capital gain multiplied by amount invested in the new house property divided by net consideration. This is the formula. Generally, how much is exempted? Amount invested or long-term capital gain, whichever is lower. But here, exemption is equal to long-term capital gain multiplied by amount invested divided by long-term net consideration. So here, in proportion to the net consideration, 54F exemption will be calculated. Now, under 54F and 54EC, no. In 54EC, 5 years is a lock-in period. Whereas in 54F, again, 3 years lock-in period. If you sell the assets within the lock-in period, earlier given exemption is re-taxed separately. It is re-taxed separately. It is not reduced from the cost of acquisition. No, nothing such. It is re-taxed separately. Sir, what is re-taxed separately? What is reduced from cost of acquisition? I am unable to recollect anything regarding this point. Ignore it. Which means you did not study these provisions properly at all. Ignore it. Don't even think about it. If at all you already studied, by this time you will be recollecting the points which I am saying. Next. So that's 54EC and 54F. Okay, 54D not relevant. Capital gain account scheme. What is capital gain account scheme? I'll simply tell you. Under 54B, if you want to invest in a house property, you have a time limit of 2 years for purchase, 3 years for construction. Under 54B, agricultural land, if you want to purchase, 2 years time limit you have. Under 54EC, to buy bond, 6 months. For 54EC, capital gain account scheme do not apply. For 54F, to purchase a house property, 2 years time. To construct, 3 years time. Now you see, in order to invest in new asset, you have 2 years, 3 years time limit like that. But you know, I sold the asset in this year and I have got a gain and I want to invest and I have a time limit. But department don't want to wait until the time. You have to file IT return, no, immediately in the next year itself, assessment year. At the time of IT return, you told the department that, sir, this 3 crore amount I will invest, sir. What is the proof that you will invest? Okay, I'll give exemption. You invest, I'll give exemption. Sir, but I have time limit of 2-3 years. How come I invest immediately? Okay, don't invest immediately. Deposit the capital gain, whatever the amount of exemption you want to claim, whatever you want to claim, how much ever you should invest so that you can claim this much exemption, whatever the amount you have to invest so that you can claim this exemption, that amount, deposit in a bank account called capital gain account scheme. Open a bank account in a nationalized bank with a name called capital gain account scheme. In that you deposit. Show me that proof. I will give you exemption at the time of filing IT return itself. If you don't deposit in capital gain account scheme within 139 subsection 1 due date, I will not give you exemption at all. But sir, you may say, sir, I have time limit of 2 years, 3 years to buy new asset. Okay, man, you buy new asset within 2-3 years only. But that amount, no. What is the proof that you invest in the new asset within 2-3 years? What is the proof? Deposit in capital gain account scheme, separate special bank account. You deposit, fine, you claim exemption. 54F. Now you see, in all these sections, The new asset must be purchased within 2 years from the date of transfer, 3 years from the date of transfer, 6 months from the date of transfer, like that. Everywhere the time limit is given from the date of transfer. Now 54F says, in case of compulsory acquisition of original asset, my original asset is compulsory acquired by the government, but 1920 year the asset is acquired, but I received compensation only in 22-23. Now capital gains I will compute in 22-23 as per 45 subsection 5. I am computing in 22-23. By this time I want to buy house, but 2 years time limit is over because government acquired in 1920. 2 years time is already over. After expiry of 2 years as per 54, whatever the section, no, I received a compensation. Now how can I claim exemption under capital gain? So 54H department is saying, in case of compulsory acquisition of capital asset, for the purpose of claiming exemption under 54, 54B, 54D, 54 EC or 54F, for the purpose of calculating these time limits, date of transfer is not considered. Date of receiving the compensation is considered. Logic. That's 54H. Almost I spent 3 hours, 2 hours 40 minutes I spent only on theory part of the capital gains. Getting it? Especially part 1. If at all you are watching this part now, sorry, I should tell this disclaimer at the beginning itself. You should be watching part 1 at first and then come and watch this. Only then you will understand. Otherwise you will not understand this part. Okay, take care. That's it. The next video which I will upload is PGBP.